Hidden owners, secret assets, financial crime. When you hear shell company, that's probably what pops into your head, right? But with the UK's rules getting much tighter for 2026, is that image really the whole story? Let's find out.
And to really get to the bottom of this, we're drawing on some expert analysis from the team at ProTax Accountant. You know, these are leading UK tax and accounting specialists. They live and breathe this stuff every single day. So they're the perfect people to show us exactly where the legal lines are drawn.
Okay, so here's the plan. We'll kick things off with what a shell company actually is. Then we're going to bust 3 massive myths: that they're all illegal, that they guarantee total anonymity, and that there's some kind of easy tax dodge. After that, we'll get into the absolute legal red lines for 2026, and we'll finish up with some expert tips on how to use these structures responsibly. All right, first things first. Before we can start busting any myths, we all need to be on the same page with a clear, factual definition.
So here's the key thing to grasp. A shell company is basically a business that's legally registered, but that's about it. It doesn't have a busy office, no staff, no products. It pretty much just exists on paper. Think of it like a vehicle that can hold assets or be used for financial transactions. Now, this structure in and of itself isn't illegal, not at all. Its legality depends entirely on what it's used for and, this is the critical part, how transparent it is.
And that brings us neatly to the biggest myth of all, the idea that every single shell company is cooked up for some kind of shady dealing. It's time to separate the Hollywood version from the reality on the ground.
Yeah, the myth is super simple. You hear shell company, you think crime. But the reality, it's way more nuanced. The truth is, when they're used correctly and transparently, these structures are perfectly legal and actually serve some very practical business functions that huge corporations and even small startups use all the time. So what do these legit uses actually look like? Well, a company might set one up as a clean holding vehicle before buying another business. Or a massive corporation could use one to neatly separate its different divisions. A really common one is what's called a dormant company. Let's say you're a freelancer in London with a brilliant business idea. You can register the name to make sure no one else takes it, but keep the company dormant, not trading until you're ready to go live. Or, picture this, a tech startup has just created some game-changing software. They could put the patent inside a separate non-trading company. Why? It shields their most valuable asset from any risks from the day-to-day business. It's a smart, protective, and 100% legal move.
Okay, that brings us to the second huge myth, that you can use a UK company to completely hide who you are. Now, you'll want to pay close attention here. This next point is absolutely crucial for any company director in the UK, because the rulebook has been totally rewritten.
So let's just ask the question straight up. With all the new regulations, is total anonymity even possible anymore for someone who owns a UK company? The short answer is a big fat no. It's really not.
And this shows you exactly why. The UK has basically built a 3-layered wall against corporate secrecy. First up, you've got the PSC register. That's persons with significant control. Anyone with over 25% of the shares or voting rights has to be publicly named. No hiding there. Second, and this is the real game changer from the new Economic Crime and Corporate Transparency Act, is mandatory ID verification. Every director and every PSC has to prove who they are. You can't just invent a name anymore. And third, Companies House itself isn't just a filing cabinet anymore. It now has real teeth. It can actively question, reject, and even remove suspicious information. The days of hiding in the shadows, they're pretty much over.
And here's a great pro tip from the folks at ProTax Accountant. All this transparency is a two-way street. Before you sign a contract or team up with a new company, do your own checks. You can pop over to the Companies House website, it's completely free, and look up their directors and their PSCs. It's a simple 5-minute check that could save you a world of pain down the line.
All right, let's talk about the money. The third myth is that shell companies are some kind of magic bullet for dodging tax. This is a really dangerous misconception, and frankly, it's where a lot of people end up in very hot water with HMRC.
Look, HMRC is crystal clear about the difference here. Legal tax planning is all about using the rules as they're written. Think things like ISAs or your pension to manage your tax bill. That's perfectly fine. But illegal tax evasion, well, that's all about deception. It's deliberately hiding your income or just plain lying on your tax return. And using a company structure specifically to hide where money came from or to conceal profits, that is a hard line you do not want to cross. Now, this is where it gets really serious. Check this out. Under the UK's Proceeds of Crime Act, or POCA as it's known, the money you save through tax evasion is legally classed as criminal property. What does that mean? It means what starts as a tax problem can instantly snowball into a money laundering investigation, and that is a far, far more serious criminal offense with much bigger penalties. But that's not all. Here's where the net gets even tighter.
Okay, now we get to the really sharp end. Let's look at the absolute hard lines you cannot cross. You want to pay close attention because the laws we're about to talk about have changed everything for UK businesses. These are the red lines that define criminal activity. You can really see how the legal net has been tightened, bit by bit, over the last 20 years or so. It kicked off with the Proceeds of Crime Act back in 2002, which set the foundation. Then in 2017, the money laundering regulations came in, forcing businesses to actually check who they were dealing with. And the 2023 Economic Crime Act, that's like the final major piece of the puzzle, bringing in mandatory ID checks and a powerful new corporate offense. Each law has methodically closed off the loophole.
And the consequences for getting this wrong, they're severe. We're talking up to 14 years in prison for money laundering. But look at the fines. They're unlimited. For that new failure to prevent fraud offense, a large company can face a fine with literally no upper limit. These aren't just slaps on the wrist. They are designed to be a massive deterrent.
So who does this new rule apply to? Well, under the Act, a large organization is any company that hits 2 out of 3 of these targets: more than 250 employees, over £18 million in assets, or, and this is the big one, a turnover of more than £36 million. If your business is in that league, you now have a legal duty to have reasonable procedures in place to stop your own people from committing fraud that benefits the company. If you don't, and fraud happens on your watch, the company itself can be held criminally responsible.
Okay, so we've covered the myths and the pretty serious legal risks. Let's shift gears now and look at how you can operate on the right side of the law. How do you actually use corporate structures responsibly in this tough new environment? Well, the government has actually laid out exactly what reasonable procedures to prevent fraud should look like. It's based on these 6 principles. It all starts with commitment from the very top. The board has to drive it. Then you've got to assess your own specific risks and put in place sensible procedures to manage them. Crucially, this means doing proper due diligence on who you work with, having clear communication and training for your staff, and constantly monitoring and reviewing to make sure your system is actually working. So, to pull all of this together, the experts at ProTax Accountant have boiled it down to 5 golden rules. Number 1, always have a clear, documented, legitimate business reason for any company you set up. 2, do your homework on absolutely everyone you do business with. 3, keep your company's house records absolutely perfect. It's a legal duty. 4, never, ever create a structure just to be deliberately confusing about who owns what. And finally, number 5, if it's anything more complex than a simple one-person company, please get professional advice before you do anything.
And on that note, it's really important for us to say that the information we've gone through here is for general guidance only. It isn't a substitute for professional legal or tax advice that's tailored to your exact situation. So before making any decisions, you really must consult an expert.
And that really leaves us with one final thought. The UK's corporate world is more transparent and more regulated than it has ever been, and the penalties for getting it wrong are incredibly severe. So the question you have to ask yourself is this: with the rules this tight, is navigating it all really worth the risk without an expert in your corner?
So, if you want to be sure your business is structured correctly and is fully compliant with all the latest UK laws, we suggest you talk to the experts at ProTax Accountant. For guidance on corporate structuring, tax compliance, or any of the things we've discussed, you can contact them directly. You can reach them on WhatsApp or by phone at 07985 689 912, or you can drop them an email at info@protaxaccountant.co.uk.